as well. We have with us Ravi Dharamshi, who's the Chief Investment Officer at ValueQuest Investment Advisors, joining us now. Ravi, thank you so much for joining in, and it's the first time we're speaking in this calendar year, so wish you and your team a very happy new year as well. At a time when you come, we have since...
and see your viewers as well.
Thank you for that. Well, at a time when you joined us, incidentally, we're seeing a steep sell-off in the market. 18,050 is where the Nifty is at right now, a 200-point cut. The one stock which is dragging the index, both the Nifty as well as the Nifty Bank, the indices, is HDFC Bank. It's currently at the low point of trade. It has been an underperformer over the last few months. Your thoughts on HDFC Bank after a spate of underperformance? If you believe that there could be re-leveraging of corporate balance sheets going forward, do you think HDFC Bank stands a chance right now from a long-term standpoint?
See, overall, we are very bullish on financials. In fact, it is one of the only space where it is actually very clear that it's a very bullish space. We are behind in terms of NPA cycle. The credit growth is actually picking up and it's in early stage of revival. Cost of funds have not gone up as much in India. So the spreads are more or less maintained for most of the banks. There will be a little bit impact on the NIMs in 1 or 2 quarters, but I think that's manageable. I think HDFC Bank has been underperforming for the past 5 years more because of other reasons rather than asset quality issues. It has been underperforming because of an exit of a stalwart leader, and then to add to that, there is an merger of a group company. So that is, we are still waiting to see what kind of synergies come out of it, how much of savings will happen. So, so those kind of things are holding back the stock more than the business cycle in the banking sector. So I would not be too worried about today's fall in HDFC Bank.
Ravi, how should we play IT now? I've never seen the streets so divided on, the IT outlook. There are many believe we are in the last leg of a down cycle, and in the next 6 months, it's going to be an attractive entry opportunity for the IT names. But there's the other half of the camp which believes that we are going to be in for significant valuation derating, and there is a case for valuation multiples to go back to pre-COVID valuation multiples, which means a decline of 30% from current levels. Where do you stand, and what would be the markers that you are looking at?
Definitely closer to the latter camp than the former camp. We are also completely underweight, in fact, zero exposure to IT sector today, as of today. We believe that from a longer term perspective, this sector has matured and it is going to be a 10-12% grower. Surely there will be some winners emerging out of it. But currently, there are too many headwinds. The customer base is not doing well. There is for sure going to be a recession in US. Intensity and the extent is something that we can debate, but there is going to be a recession, and that will contract the multiple for the US tech companies as well as the Indian tech companies. And the attrition problem is coming, but it was more of the demand issue. I think there will be a lot of downgrades. And it's not only US, in fact, even the European geography is facing a lot of headwind. So I think there will be a lot of downgrade in this sector post this quarter result, where the management will come and say that the outlook is hazy, and mid-quarter they can actually revise it further downward. So we are staying away from IT sector. I don't know whether we will correct 20% or 30%, but we'll wait and see for another 1 or maybe 2 quarters before we start getting constructive on this again.
Okay, all right. Not, too optimistic on IT, still a little bit cautious. Hi, Ravi. Wishing you, your team, your family a cracking 2023. Always good hearing your thoughts. Ravi, last year...
Nigel, wish you too a Happy New Year.
All right. Ravi, 2022, numerous times when we chatted, these value-oriented stocks, some of them, PSUs, some of them dividend yield stocks, they took center stage and they surprised everybody, the big outperformers last year. Now in 2023, are you expecting more of the same, or do you expect gradually that move from value towards growth stocks?
So I think 23 is going to be a tale of two halves, where the first half is more of the same and the second half will be where we pivot away again towards growth stocks. So what I foresee what's going to happen is that currently world will continue to deteriorate. the fundamentals will continue to deteriorate. And in that deteriorating environment, India is likely to outperform and value growth is likely to outperform. Value is likely to outperform growth. But as Fed realizes that most of the, except for wages and jobs, which are the only two sticky points in inflation, everything else has started coming off. So sooner or later, Fed will pivot, and so they have already started slowing down the rate of hike. They will eventually pause and start cutting also towards the end, where I believe that the pain in the economy will start showing up so much that Fed will have no choice to cut. So basically, the path to Fed pivoting leads through a recession. So we have no choice but to go through a recession in US. So when the recession pain shows up, markets will mostly react negatively. But eventually, when Fed starts pivoting, I think that's where the support for the markets will come through. And at that point of time, again, one should pivot towards growth stocks rather than value stocks, is what I feel.
Right. I do see a couple of themes that you like. You do like some of the manufacturing names. You do like a bunch of companies which are OEMs, etc. One of them that stands out in the list is Keynes. It provides process engineering, integrated manufacturing, life cycle support to OEMs, etc. In this, what are your thoughts? I mean, in the OEM manufacturing space?
India is actually in a very sweet spot. So not only do we have a government that is supporting the manufacturing sector, we also have geopolitical realignment of supply chain in the world, which is leading to a lot of European and US customers demanding a second supplier, a second vendor, if not entirely replacing China. So we have pull and push factors working in our favor for the manufacturing sector. So the first set of companies which were given PLI incentives like mobile manufacturing, which is essentially an assembly operation, is already a success story. But the second set of companies, which is essentially the ecosystem around it, whether it is the components or the chips, eventually has to come to India if we have to make manufacturing really a big success story. So I believe that the rest of the ecosystem has started towards India. And without naming any company, I would say that electronic component manufacturing in India is going to pick up in a big way over the next 5 years. Yes, at this juncture, valuation might seem a little stretched from 1 year perspective, but I believe that growth trajectory is so strong over here that over the 4 or 5 year horizon, you will end up making a CAGR even from this, even if you end up buying at this point, from where you can see either 6-12 months of underperformance or maybe 10% kind of a correction in the stock price.
Okay, all right. And one of those disclosed names that's already on the exchanges, that's up for you on the screen, Keynes Technology, as we all know. But Ravi, one other sector that did very, very well was defense. The central government's focus out there, there's a big push that we're seeing to defense companies, and they have done well. The question is, now is it a good entry opportunity for a longer term investor, or do you believe you'll buy it only on a dip?
So clearly one round of re-rating has happened. See, the secular trend in defense manufacturing is here to stay. In my opinion, India has no choice but to become self-sufficient in production of defense equipment. So, and government has taken all the steps. And the last step, which was the most important step, was banning the import of about 400 odd items. And if there is not going to be import, then there is no choice left for the Army, Navy, and Air Force to actually start procuring this equipment locally. So that has started. So about 1 lakh 25 crore kind of equipment manufacturing, which used to be imported, will start getting manufactured domestically over the next 4 or 5 years. And that is a huge opportunity for the sector, which was very, very small. This sector is still in a very, very infancy phase. And at this point, it is only the public sector, government-owned companies that are actually capable and able to grab the opportunity. So I believe this story is definitely for the longer term. But as you mentioned, yes, there could be some consolidation. This might not be the best entry point. But again, as I'm saying, if you stretch your horizon to 3-4 years, I don't see an issue over here. I think the wealth creation over here is still pending.
Thank you very much, Ravi, for joining in. For the markets, we're at 18,050. The markets went down to levels of 18,020, but from there, it's managed to climb up close to about 20 odd points. There you can see that very mini bounce that we saw in the last 10 minutes. Still down 180 points on the Nifty, the Sensex lower by 650 points. We had Mitesh earlier telling us that a break below 18,000 level, 18,000 level opens the floodgates to lower levels, and that's where he would take a short position. So for now, we're holding still in that range, 18,050, but closer to the lower end. Some updates coming in on some order wins for GIPCL. Get into a break. On the other side, we'll get you a quick check on what dealing rooms are saying in our segment D Street Chatter. We'll also get you a few